Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hey, Jackie. It's Bill Yount with my co-host, Jackie Cummins-Koski. Today is a Wednesday episode of Catching Up to FI, and this one is special because it's different. I have not heard anything like this in the podcast world and the financial independence community. You guys got to stay for this one, and actually, we would encourage you to jump over to YouTube to watch it.
Yeah, so this was done live while we were in Knoxville, Tennessee at the University of Tennessee School of Agriculture. This was a lot of fun. I definitely saw your energy and your passion for financial literacy, and it reminded me of why we were doing this and that we wanted to have an impact on the younger generation. We want to take what we've learned, even as late starters, and share it. So that's exactly what we did.
Yeah, we jump-started their interest in financial literacy. It lights a fire under the rear ends of college students that are about to enter the working world. It's raw. There's a lot of great questions and dialogue to this. And we're just proud of the students and Professor DeLong for inviting us to make a little difference in a few young people's lives.
Yeah, so the recording was just several segments that I decided to just hit record. We were mic'd up, so the audio should be pretty good. Were those new mics pretty decent, Bill?
Yeah, you techie. You're all into your man on the run or woman on the road, catching up to FI on the road stuff. And you know what? I'm getting used to it. This stuff is meaningful, and not only to us, but to them. And we hope it's meaningful to you and inspires you to spread the word of catching up to FI.
Yeah, these are just highlights, just like I said, snippets that we recorded and we put them together just to give you a sense of this is something that you could certainly do too, because we hold a lot of knowledge. How can you impact your community, your local high school, your local university? So Bill and I did this together. We put a presentation together. I will actually provide a link to the presentation that we use. You don't have to use the same exact thing, but I have been asked, Bill, in the past, can you show me what you guys use? And honestly, we weren't following the presentation to the T. Our whole idea was to have that as a guide, but what we really wanted was interaction from the students, question from the students on what was on their mind, and we just did a lot of answering and try to make it interactive. And you know what, Bill? We did a giveaway too to the students, right?
Yeah, actually, Bill Bernstein, one of our recent guests, wrote this pamphlet, a manifesto, 16 pages called If You Can. And it's basically an introductory how-to guide to launch you into your financial life. And it sort of helps you with a bibliography. Okay, if this is meaningful to you, go read this or go read that. And anybody can read 16 pages, even you, Jackie, or you can upload the PDF to audiobooks and listen to it, I think, like you did. But we gave them each a free copy, and a couple of them got a Fire for Dummies book, I think, too. Yeah. There's lots of ways to learn. You like podcasts. I like reading. Hopefully the students read it, because if they do, it will change their lives.
Yeah, and another shout out to Dr. Karen DeLong, who brought us in. So that If You Can book by Bill Bernstein, that is his best-selling book, and it's available for free if they want the digital version, but we went ahead and got them each a copy of the printed version, which is a thin little thing. But also, I cannot leave without giving away my $2 bills and telling the story about the $2 bills, because it just goes to show no matter how small it is, you should always save something. So I give them the backstory, which if anyone doesn't know it, basically when I was in high school, I got my first paycheck, went to cash that check. When you actually had to go to the bank, they gave me a $2 bill back. So every time I went back to cash my check, I asked for $2 bills. And I would not spend them. I kept collecting them all through high school, all through college, even as an adult, until one day my daughter asked me how many $2 bills I had. And I said, I don't know. Let's count them. So we counted them, and I had 1,900 $2 bills. And I said, oh, I was learning to save before I knew it. I was working that muscle, and I couldn't just turn them back in at the bank or go spend them at the store. So I decided, as I do these financial literacy sessions, financial education, whether they're adults or if they're students, I was going to give away those $2 bills to represent that this is my big lesson and my first lesson about saving and investing, no matter how small. So they got that lesson and they got their $2 bill.
I got a $2 bill when I first met you. You know, I feel very fortunate to be in the $2 bill, Jackie Cummins-Koski Club. So yeah, they make great bookmarks. Everybody will have their things because you got to make it fun. You got to make it interactive. A lecture does not work. You know, I was lecture daddy to my kids. It's got to be interactive. It's got to be fun, engaging, and you want to answer their questions. So ask them for their questions before you go throw up some slides and then riff on it. Just go with it anywhere it takes you, because in the end, they're going to remember 1, 2, or 3 things. But if you light their curiosity, you've done a big service to their financial lives.
That's right. And Bill, you probably didn't realize I was recording, but you were talking to 2 of the students after the session, and I started recording. And I think that might have been the most valuable time, the entire time that we were in the classroom. It was absolutely gold. But we have a lot of great highlights, including that particular segment at the very end when you were talking to the students. But we just wanted to share this with you to show you what we're trying to do outside of the podcast to make an impact on the world when it comes to financial education and financial literacy, again, in observance of Financial Literacy Month. And it was just so much fun. Got to be local with Bill, and we're happy to kick it over to these highlights, right, Bill?
Yeah, go get the link for this presentation. It's for free here in the show notes, and maybe we can make it available on the web as well, because it makes it easier for you. No friction. You don't have to create it. It's there for the taking, and it's important to do this. And let's catch up to FI together. But Jackie, how do we close every show?
Yeah, always remember, it's never too late to start. It's better late than never. And it's always the right time to catch up to FI. You'll get it right one day. Here's the video.
All right, thanks, Professor DeLong. This is Jackie, and I'm Bill.
Hey, how are you guys doing?
We're excited to be here. Actually, Jackie's been doing this for 5 or 6 years. I started joining her to do this last year. I'll start. I'm Bill Yao. I'm a physician. I'm still practicing emergency medicine here in the area. I've been here 14 years, and I'm a famous late starter. I didn't know what a net worth was when I was 50 years old. I'm the classic rich doctor syndrome where, you know, money in, money out, spend it first, save it later. And I woke up at 50 saying, my goodness, I got to take care of myself. I got to retire someday. And out of that was born a journey that's taken about 10, 11, 12 years, and I'm now financially independent. I'm cutting back on work. I got it together. And although I was late, I've had a very robust life and balanced life, and money is a big part of that. So Jackie has a very different story. Together, we do a podcast called Catching Up to FI, Catching Up to Financial Independence, because the majority of Americans are late starters. The average age at which people start saving for retirement is about 31. I can tell you it's probably later. The vast majority of the country would consider themselves late starters, and 40% of the country rely on Social Security alone for their retirement. And that is not enough. That's not what you're going to want. We're here to help you ignite your curiosity in becoming financially independent and being a good steward of your money along the way. Because it's not only good for you, it's green for the world, as you guys are all involved in too with your agriculture focus. Let my partner in crime introduce herself.
Hey guys, thank you, Karen, for letting us come and chat with your class. The huge benefit that you guys have is that you are getting an early start, and you've got an amazing professor like Karen that is bringing this to you, and we're open to any questions that you have. Like Bill said, we are quite the opposite. So he's the doctor with the high income and all of that. For me, I grew up in poverty in a small town called Aiken, South Carolina. Agriculture was very big there. I was raised by a single dad with 6 kids. So like we were hand to mouth, paycheck to paycheck and all of that. But as life went on, one of the things I did right early on, I did go to college. I got a college degree, so I was happy about that. Not any crazy student loan debts, thankful for that too. Go on through life, I end up getting married, have a daughter, and about 10 years later, I got a divorce. And that is what woke me up about my money. I was just sort of on autopilot. Somebody said, take the match at work, with your 401k. And so I did that, and turns out that wasn't enough. So I got myself together. I was making less than 6 figures, so I wasn't even a big income earner, but I did really good with the money that I had. That became way more important. One of the organizations that sort of supports us in this effort is called Better Investing. So I sit on the board of directors there. I'm author of a book called 5 for Dummies, and our podcast is Catch It Up to 5. So let's hit the next one, Bill. Probably 2.
I want to say too, and I'm going to blow some smoke up my partner's ass, literally, because she is an inspiration. She's the American dream. Well, a lot of the questions you guys had, well, how do I save on low income? Well, she did her journey to being a multimillionaire, never earning more than $100,000. Okay, I had the big shovel, I had the high income. There's a whole spectrum. Everybody's numbers are different, but financial independence is reachable for each and every one of you wherever you are in your life, in your income. So the message here is get curious about money and realize that you have the power to become financially independent and don't have to necessarily wait till you're 65. So anybody can do this at any income.
Yeah, so one of the big takeaways is that even though he's the high income doctor, with 2 income household and all of that, and I'm the poor little black girl from South Carolina, we're both financially independent. So that means that anyone can do it, but it's like all these nuggets when it comes to finances and money, it's not enough out there. So because if you start when you're young, it really gets you ahead of the game. So we're both financially independent. I retired at 49. And Bill is still working. When are you going to retire, Bill?
Well, that's the question in the room. That's what I call the fog of FI, or the fear of getting out. One of the things is, you may think that retirement's a number. Yeah, there's a number I need to get to. But once you reach that number, it's like climbing a mountain. What's next? And how do I get out? And how do I migrate down? What are my passions and what am I going to do next? I'm going to go from taking care of people's health care to taking care of people's wealth. My passion is this: financial education, financial literacy, financial wellness, how to lead a balanced life and use money as your ally, as a tool in order to have your best life, which we're all interested in. So I'm very excited about getting out of emergency health care. I'm done, and I've just cut for the first time now 2 shifts from my work, and I'm on the way. And I'm migrating to the next chapter. So.
Yeah, and everyone's journey is different. Everybody in this room will be different. So we want to get to know you guys. We're done with our boring part. Okay. So I'm always curious, is there anyone in here that took a personal finance class when they were in high school?
How many of you did it in Tennessee because you were required to do it? No. How many of you learned anything? There you go. That's interesting.
Okay, so we're hoping to carry the torch with that and help you get your questions answered, because most of you guys are only really close to going out into the world and having to spend that money when you get your first job. Anybody has a job or an internship right now? Okay, awesome. Okay. You already got that money rolling in.
Once you have a paycheck, then it becomes important to know what to do with your money, right? You have to know how to partition your paycheck. Okay, what do I do with it? Is it all there to spend? Well, no. And we're going to talk about how to think about partitioning your paycheck.
Okay, here's a big one. Has anyone started investing yet? Whether it's with your parents? Okay, awesome.
Great.
Okay, we got a few people. Great. I know I didn't start investing. I didn't even think of my 401k as investing, but that was my first way. Okay, I'm curious, what are you investing in? For anybody that raised their hand, can you share 1 or 2 people?
I think you raised your hand. I'll out you. What are you investing in?
Stocks and ETFs, those 2.
Individual stocks?
Yeah.
Okay, that's
Awesome.
one thing.
An ETF,
what's your individual stock? What's your flyer there?
Carlisle's been good so far. That's
Okay.
one of the big ones.
Okay.
And what ETF are you investing in?
CGGR, the Capital Growth Group, and Vanguard.
But ETFs, and we can talk a little bit about that. That's
Very
interesting.
good.
There was somebody else that was investing. I saw another hand somewhere. No? Nobody's going to
right here.
fess up to it?
Yeah.
Go ahead.
I was going to say stocks as well, individual stocks.
Individual stocks. Okay.
And you said you invested as well?
It's been a while since I've
Okay. Who here has a Roth IRA already? Okay. 1, 2,
awesome.
3, 4, 5. I do.
Well,
I'll
guess
trade
what?
that.
There's investments inside there, and we'll get to that.
Yeah.
Okay. What do you hope to get out of today's talk? Anybody just have something burning that they're like, nobody ever taught me this. Nobody ever told me this.
And please don't be afraid. We're very transparent. We'll tell you anything. We'll share numbers with you. You shouldn't be afraid to talk about money.
Okay, got one over here.
I have one. So I was curious about when you switch occupations or jobs. Say like you sign up, like you said, you match like a 401k, but say you move jobs now, that's different. Like, how does that stack up, or do your previous savings like kind of follow you as you go to your next job? Or
That's a very good question.
That is very quick. And Karen sent us a lot of the questions that you guys, or all of them that you asked. And that was one of the best ones, because even adults don't know what to do when they leave a job. And there's a lot of money left behind when it comes to 401k. We'll definitely answer that question, but that's a very good one.
What is there? There's like $1 trillion in lost 401ks.
I think it's 2.1 trillion that's left
whatever,
behind.
trillion is still a lot.
Yeah,
So
it's a lot.
there's a lot of lost money there where people forgot to manage that appropriately and bring it forward with them. Or they have 13 of them, because you guys are going to probably have 7 jobs in your career. It's not like 9 to 5 for 40 years and then you're done with a gold watch. Today's economy is very different. It's very mobile, very nimble, and you've got to keep your money up with you. You can go in here, link your accounts, and know what your net worth is. Okay, there's my net worth. Okay, where'd my money go last week? And I can even ask it with AI, how much did I spend on dog food this year? Oh my God, my dogs are really expensive. So there's an AI assistant in here. If you're into that, you can type in a query or report to get reports on anything you want to know. I mean, how much did I spend on Starbucks this year? I'm addicted to Starbucks, okay? And maybe you are too, or maybe you're addicted to DoorDash. That is a big hole in the bucket, actually. And we can talk about those rocks that you can control. But I probably spend $1,500 to $2,000 a year on Starbucks. What is the opportunity cost if I didn't go to Starbucks? I made my own coffee, put $2,000 a year in the market and watched it grow. Well, that's tens of thousands of dollars that it would be in 20 years if I didn't go to Starbucks. So these little expenses, even the little ones, your cable bill, all these things, all these subscriptions that you might have running in the background, you've got to know what these are, you got to know where it's going, and you got to spend according to your values. If you guys gave me your credit card statements, I could tell you what's important to you. I can tell you what your values are, because money is the way you vote. You vote with your money. And we have to talk about what money is, Roy, because it's so many things. It isn't just a dollar bill. Anyway, Jackie, I digress.
No, that's great. I mean, with today's technology, it's as easy as an app like Monarch Money or anything like that, where you got it in the palm of your hand and you can keep up with where your money's going, how much you're saving, how much you're investing. And for savings rate, when it comes to financial independence, this is one of the most famous guys, Mr. Money Mustache. But this is a simple chart that will show you, based on your savings rate, how long will it take you to reach financial independence. So if you decide, hey, I'm going to save the 20% that everyone says I should save, that's totally fine. The blue is assuming that 9%, and then I ratchet it down if you happen to be more conservative, 37%. But you can see 20%, hey, you'll retire like most people, around the same age that most people retire. But as you start to ratchet it up, 30%, 40%, 50%, now it might be hard to get there. If you're a high earner, maybe you'll make it, but if you can get your savings rate all the way up there, you're less than 9 years. That's pretty darn
these guys
good.
are eating rice and beans, okay?
Yeah.
It's hurting. That's what Dave Ramsey said. Rice and beans, if you ever listen to him. And so it's hurting a little bit. You're probably sacrificing a little bit here. And then
Unless you're a really high income earner, as some people are.
And then here you're kind of like, well,
more
I don't
realistic.
mind working 40 years. It's okay. I'll do it. The slow and steady wins the race. What I had to do at 50 in order to catch up and get to our number in 10, 12 years, and the markets have cooperated and helped me. We've had a tailwind. I had to do this, okay? But if you start now, all you got to do is save a little bit, much less. I had to really cut into, we went from single-digit savers within a year to 40%.
So what is your assumed income for that?
It doesn't matter.
Yeah.
This is all based on expenses and the gap. I mean, the number you need to know is how much does it cost me to live a comfortable life? And that tells you, and then what am I earning? And then once you know that number, 25 times those expenses tells you this is what I need, and then you can figure out your timeline.
This is a personal question, but part of what you guys do on the podcast is answer personal questions. Because a lot of people don't talk about personal finance because they think it's rude to talk about how much money they make or how much money they save. So I'm going to ask you a personal question. You don't have to answer it. But are you saying at 50, like you had a zero balance in your retirement account?
I don't know what it was because I didn't pay attention. I don't know what my net worth was at 50, okay? I had been saving in retirement, but I did it at tax time. I did it last. Budgeting is actually really easy. When you have lower amounts that you're working with, you probably have to have a prospective budget where I'm not going to spend more than this on Starbucks a month, and this is what I allot to it. What I did was a reverse budget. I said, okay, this is our income. I got to save 40%, so that goes first. I automate it, it gets out of the account, it gets into all the retirement vehicles that we can talk about. And then I know at that point, okay, I'm going to be done in 12 years, so I can spend the rest. I can enjoy the rest. It may go to taxes too, but it's going to go to travel, it's going to go to food, it's going to go to housing. But then you know what you have to work with to live your life. I mean, one of the things that the famous J.L. Collins says, who wrote The Simple Path to Wealth, which is a book we'll recommend at the end, was, live on half if you can. And when you get to the appropriate income, and Jackie saved, 40% on an $80,000, $90,000 income,
Yeah,
right?
I got up there, yeah.
And how much did you retire with at 49?
Yeah, it was 1.3. And yeah, I don't mind sharing my numbers. They were a little more modest. So I was 38 when I woke up, and I had gotten divorced a couple years prior to that. And at the time of the divorce, you look at both retirement accounts. So this is how I remember it so well. I only had $20,000. And at the time, I was about 34, 35 years old. $20,000. Okay, you guys can easily do that in like 5 years easily. Now, when I got divorced, it was interesting because in his retirement account, he had $120,000. So it was $100,000 more than mine. So this baffled me. I felt very financially ignorant that, one, I didn't know there was that big disparity. And it came down to he was investing in different things. Women are typically more conservative when it comes to investing. I'm not necessarily anymore. And so by the time we got divorced, that was all equalized. So I ended up with about $60,000. But I'm almost 40 years old, and that's all I had. And once I woke up, that's when I started learning about this personal finance stuff, because I'm like, this is crazy. This is ridiculous that I don't know all this stuff. And so I went on this, journey. Joining Better Investing was like the first thing, because I was kind of afraid of investing. It was kind of intimidating to me. And once I got over that, then I was like off to the races. And it really only took me about 10, 12 years to go from that $60,000 to $1.3 million. And my average salary was probably around 80,000-ish. So I wasn't even making a big income, but I was just being smarter with my money. I wasn't afraid to invest. I was maxing out all of my accounts and things like that. And that kind of brings everything together to say, how do all these moving parts even make sense to where I don't have to work anymore and I have the money that I need?
All right, read this article.
Yep.
We lay it out here, but this article changed my life. There's a couple articles. I mean, it's a blog. This is a guy retired at 30 with just over $1 million. He was a six-figure, $110,000 guy, Mr. Money Mustache. He lives in Longmont, Colorado. I've met him. He's a friend. He helps so many people for free, very generously. And it has nothing to do with reading a textbook. It could be one blog that changes your life. And I'll share my numbers too. More money, more problems, okay? More zeros, more problems, more lifestyle inflation. And look what she did. Okay, you asked what was my net worth. It was under $1 million. Let's say that. I'm sure, because we had a mortgage still, we hadn't paid off our house, and we had been saving for retirement for not much, and we hadn't paid attention. Well, say I went from under $1 million to $5.5 million in 10 years just by following what we're talking about this today. And I needed that much because our lifestyle cost more. Everybody's numbers are different. She's retired. I'm not. And her lifestyle, I can't say is that much different from mine. And when we went from 8, 9, 10% savings to 40, and basically we lived on my income and saved my wife's income, that was a superpower in the dual income household. And we had access to things like solo 401ks, which is because we were 1099 contractors. Those are things you probably haven't heard of, but you will learn them. So we were able to save tons of money, and our lifestyle didn't change. We had 2 kids, we had a bigger house, but in order to get there and increase the gap, we sold the big doctor house and moved into a house half the size. And I'll tell you, it's much harder to deflate your lifestyle when you've let it get away from you than it is to inflate it. Just like it's much easier to gain weight than it is to lose it. Look at me. Anyway.
I was about to say, you know, you got that big house. You live in a big life. Okay, so let's have a little fun. So these are stocks in the agriculture space. We got Tractor Supply, Deere, Scott's Miracle-Gro, Archer Daniels, and Duluth Trading. So we've done this for the past 5 years. So I'm curious, which one of these stocks, now we're only looking at the last year, the last 1 year. Which
and remember, these are individual stocks.
Individual stocks.
Which is one company.
So which one do you think performed the best over the last year? And the last year is from March 2025 to February 2026. So who thinks Tractor Supply performed better than any of the other ones over the last year?
And you got to answer, just like the question. You got to answer. You got to hold your hand up.
Okay, so nobody thinks Tractor Supply. Okay, what about Deere? Who thinks Deere would have performed the best? Okay, we got a few hands. Okay, what about Scott's Miracle-Gro? Okay, we got a few for that one. What about Archer Daniels? Who thinks that one? Okay, got a few people. Duluth Trading? Anybody think that one? Okay, so we're firmly split on which one we think did better in the last year, okay? Sorry, I forgot about the hint, but the hint was that the S&P 500 was up 13%, so keep that in mind, all right? So this is how they worked out. So Tractor Supply and Duluth, they were the worst over the last year, and we see that our clear winner is Archer Daniels up at 48%. So that's interesting, but it's hard to judge a stock by just looking at 1 year, okay?
Actually, you should never do that.
Any investment.
Most recent past performance does not guarantee future results. Individual stocks are concentrated risk. It was an older way of investing. There's much more modern technologies in how to invest. And guess what? Jackie and I don't agree on this. She has an individual stock portfolio because she learned through better investing, but she had the interest and ability to take a deep dive on companies and say, this is a company that has a long view, a long-term benefit for me. I don't have that interest. I mean, I don't want to do that work. That's work. And this was the way our parents and our grandparents invested. Things have changed, and you were invested in the S&P 500, right? Weren't you, or something? You were an ETF
and individual
You were in
stocks.
some kind of ETF, and that is a fund of companies.
Spreads
where
it out.
You're diluting your risk because you'll have companies that are, maybe the majority of them are not doing well, but then there will be, just like in the S&P 500, the top 7 companies, the Magnificent 7, your Googles, your Amazons, your Microsofts, your Apples, they make up 40% of the S&P 500. And a lot of the returns are based on those, but you're investing in the whole market. And there are going to be companies that rise up, and there are going to be companies that slide down. And it's going to cleanse itself. So I invest in the whole market.
Yeah, and we'll look at that a little bit later as well. So let's pull back a little bit and let's look at a bigger time horizon. So over the last 5 years. So you asked the question, okay, is it the same one, Archer Daniels, has done well over the past 5 years? That might be even more important. So let's do the same thing. So over the last 5 years, who thinks Tractor Supply would have come out on top? Okay, we got a couple.
And
Deere.
notice the top line here.
We had a lot of people to say Deere over the last 5 years. What about Scott's Miracle-Gro? Anybody think that would have came out on top? No, okay, so down for them. Archer Daniels? Anybody think Archer Daniels? Okay, what about Duluth Trading?
They don't want to vote.
That's fine. But the most,
you don't have any idea, right?
the most response we got was for, I believe, Deere. Okay, so let's see. Deere was the winner here. So over the last 5 years, Deere has done very well. But look at Scott's Miracle-Gro. When we only looked at 1 year, it was down, but not that bad. And, you know, over the last year, both Scott's Miracle-Gro and Duluth down like hugely. So it is hard to figure out when it comes to individual stocks.
And the point here is, you know, you can investigate the companies and you may be right, but there's a lot of luck that plays in here. I mean, if somebody bought Apple 20, 30 years ago.
Or NVIDIA.
Yeah, or NVIDIA or whatever, 10 years ago, maybe.
Only one share. My class had to do it.
Yeah. And
Yay! Looking good
they may
right
be
now.
retired and multimillionaires, or say Bitcoin before it crashed this year and has a bear market. But it's going to go up and down. And when you have concentrated risk, that company can go to zero. It can go bankrupt. You can lose all your money. Okay. You can go to the moon or you can go to zero. And you don't know what it's going to do necessarily unless you have carnal knowledge of that company. Apple almost went bankrupt, right? You weren't even born then. So at any rate, individual stocks are a tool, but it's a much riskier tool than something else we're going to tell you about.
Yeah, and that's kind of what's being shown here. There's a lot of parts, moving parts that you have to look at. Now, like I said, I was part of Better Investing and they're part of who brought us here today. They have a tool that helps to do that. But again, it's going to take somebody that has the inclination and the interest. And I do, the vast majority of people probably don't need to mess with individual stocks. But if you do, use some type of tool or resource that's going to help
and the other
give you
piece
some
I would
idea.
say too, what percentage of your portfolio is in individual stocks?
Oh yeah, it's not that big. So my overall portfolio, and since I retired, I've been retired for 6 years. I retired at the end of 2019.
And that's
right
when we
before
met. I
COVID.
met her right before she retired.
Yeah, we met right after that. And so, so I had 1.3 million at that time. 6 years ahead, it's like at 2.2 million. So it's grown because I'm living off of a smaller amount, about 4%, than what it's growing. It's growing at about 9% or more. But my overall portfolio, individual stocks only represents about 10%. So mostly things are in index funds or ETFs where it's spread across a whole bunch of stocks and investments and not just one. But I do enjoy having an individual stock portfolio. Like you said, we disagree
and
with
you
this.
guys might too. There's nothing wrong with that. I'm no individual stocks. Actually, I owned Berkshire Hathaway for a while, but I was like,
you sold that?
I sold it.
Oh, man.
When I went into the retirement portfolio, it got gone. But anyway, you can do that, but I would not recommend doing it with more than 5 to 10% is a lot, but 5% of your money. You can take a flyer. I have 1% of mine now that Bitcoin's down in Bitcoin, okay? It's not an investment. It's a speculation.
That's debatable. Some people do call it an investment. That's debatable.
What is the definition of investment as far as a stock? Okay, it has capital appreciation or growth with cash flow or dividends. So a true investment is going to be spinning off cash at some level, and there are ones that do that more than others. But Bitcoin, it doesn't spin off any cash. It's all capital appreciation or depreciation, and it's highly volatile. Now, there's advantages to having volatility, and then there's gambling, which is where there's an expected loss. You go to a casino.
Yeah, we got a question over here.
Oh, sorry, go ahead.
For you, on your individual stocks, if say one of your stocks is a really good year or a really good 2 years, do you have a method of when is enough and when to pull it out? Or
so you're basically asking, how do I know when to sell?
Yeah.
That is the hardest part. These days, I'm mainly sticking with larger companies that I don't have to watch all the time, and things like Apple, Berkshire Hathaway. I do have NVIDIA. If I can double my money over, let's say 5 or 10 years or so, I'm a long-term investor, and the things I'm showing you with Better Investing, it's the same type of principles. Sometimes there might be personal reasons that I want to sell them. Like, for instance, recently I got out of Tesla, and I don't panic sell. So I didn't want to be an owner of Tesla anymore, but I'm like, you know what? I think it's still gonna run a little bit. And I just ran it through this tool to look at some data points to make sure I didn't feel like it was gonna crash. So I probably kept it for almost another year before I decided, you know what? It's getting to a high point where I'm satisfied. I've made what I wanted to make and I'm getting out of this. So I try not to panic sell, and I have to decide. Usually it's not because I need the money, but it's just that I'm constantly looking at my portfolio as a whole. And at one point, I think I had too many tech companies. So which ones were my favorite that I wanted to keep, which ones I didn't. And then at some point, I just had way too many stocks. So I pared it down. At one point, I probably had 25 stocks, and there's no way I could follow all those stocks. So right now, I have about 10 high quality companies that I don't necessarily need to watch. And I don't have any desire to sell any of them anytime soon. So I'm hoping that for me, most stocks is between 5 and 10 years. And I have a handful that I've had for, almost 20 years, and I'm just letting them ride.
Well, that's the thing. Investing is a long-term sport. Short-term trading is kind of more gambling. It's higher cost. And then we are long-term investors. You're buying Just keep buying through market ups and downs through your career. Just keep buying. Because what happens there is over the course of 20, 30 years, you'll buy low. Now, when the market crashes, and it will crash again, we've had 15, 18 years of a bull market, unprecedented in history. And at your age, you haven't experienced a crash like the 2008 financial crisis. That will happen. Market has cycles. And by the way, all the questions you gave us are the questions I wish I'd have asked when I was 20. So great questions. And we have a surprise for you at the end about how we want to answer them.
Well, we could talk about this, and maybe we could take a few questions that we got that we thought were really cool that came up again and again. So there's like 4 bullets.
Okay, well, what we got here? What you don't spend goes in your pocket and will grow for you and compound for you. Every dollar needs a job. You need to think, what is this going to do for me? Okay, and if I don't buy Starbucks and I put it into investing, I am buying my financial freedom. I am buying the future. I am buying freedom from my job. But there are funds that if you spend more than 0.1% in what's called an expense ratio for an ETF or a fund, and this is the golden age of investing where it is cheap. It's never been easier. It's never been cheaper. You can get to financial independence better than they could 30, 40 years ago. But that's an expense ratio for a fund that it costs the company to manage the fund. And you want to have funds with low expense ratios. The S&P 500 is 0.03 or 0.04%. That's like hundreds of dollars a year, and it's going to be a small percentage of what that growth is. Passive means that you don't have managers actively managing it. That costs money. It's going to add another one, and those are hidden fees. They're going to charge you another 1% to 2% to manage that money, and you don't need to do that. You can be passive and just buy the whole market, buy the haystack, and you'll get all the winners. You'll own NVIDIA, Microsoft, all this stuff, but you just don't have to own it in one concentrated, risky slot. Diversified, okay? You diversify your
All
risk
these companies
across the entire market. You know, you're going to have losers. That's fine. There's going to be winners that will compensate for the losers. And over time, the winners always do better than the losers. The market always goes up every year about 70, 75% of the time. And
Yeah, there's a quick slide for that. Why don't we show that? Let me click. Okay. Yeah, I just like to kind of, we'll talk about the 401k really quick because.
I'm sorry, there's so much here. But the point is the mindset is really important. The tools and the math are important too, but people jump to the math without looking at themselves, looking inside themselves and saying, okay, what are my values? What is my mindset around money? Does it pair with my spouse? Are we on the same page, working towards the same goals? So don't do the math first. Know yourself first, and then the math is all pretty straightforward.
Yeah, and most of you guys are 21, 22 years old. So I went back for the last 20 years just to give you an example. Again, the S&P 500 is the 500 largest companies. We just saw them. If you're wearing Nike shoes, Nike is in the S&P 500. McDonald's, Chipotle, those are companies that you know. So this is a very common benchmark. So I went back and said, okay, how many times if you just simply invest in an S&P 500 index fund, over the last 20 years, it was only down 3 times. That means the other 17 times it was up. And then he challenged me and he said, oh, that's not representative. Well, if you go back far enough, I went back 60 years. He's 60 years old. And 78% of the time, the S&P 500 was still up. So what does that say? That just says if you start with something as simple as an S&P 500 index fund, you're gonna be okay. You don't need to do the individual stocks. You don't need to do fancy stuff. If you want to and you have the inclination, that's totally fine. But if you wanted it as simple as possible, this is a great start. So what I want to do, she had a question and was brave enough to ask it. Why don't we answer her question? You remember what her question was?
I think we did. We answered your question.
No, she wanted to know about what you do with a 401k after you leave your job. So I'll start
you take
with
that one.
Yeah, I'll take that one. On average, these days, people change jobs 12 times during their working career. So that's a great question. Probably every job had a 401k. So when you leave, you have a few different options. One thing I want to point out is that when you guys are evaluating job offers, there could be something called vesting. That's just a fancy word to say if you get a company match. Companies will generally match. So when you see where it says, oh, we have a 401k match, that means they will match what you put in. The typical match is about up to 6%. They'll match it dollar for dollar. Now, a lot of times, most companies, they call this a retention tool to try to keep employers longer. They'll have something called vesting where you have to be with the company a certain amount of time to get that employer match to keep it if you leave. Now, you always get the part you put in, but the part the company put in, they could say, okay, you need to be here at least 3 years for you to be vested and for you to be able to take this money with you. Now, it'll be written out exactly what that is because sometimes it's a little bit different. So when you do leave, you have a few options. You can roll it over to an IRA. An IRA is an individual retirement account. So that means it belongs to you and has nothing to do with the employer.
And then you can invest in anything you want and have because when you're in a plan, and we probably should show that, they have a menu that you choose from, and it's an alphabet soup. And you got to look, and Jackie has done a marvelous job saying, let's clean up the mess of your 401k and let's make it easy. You got to sit down with someone to navigate this. You want to show them that real quick?
Yeah, it's just, I call it the Great 401 Cleanup because this has been like the bane of my existence because most people have no idea what to do with it. But the QR code is live. This steps you through, like when you go to get your first job and they start talking about a 401k and you have no idea, this could be a good guide to kind of step you through it. So your options, you could roll it over to IRA. A lot of people just leave it with their company. The only reason I don't like that is people forget about it. When you go to the new employer, if they allow it, you may be able to roll it into the new employer. And those are the main reasons. Some people, unfortunately, do cash it out. You probably don't want to cash it out.
Don't do it. No. Don't do it.
Because that stops your growth right there. If it's really, really small, I would say, I think it's like less than $1,000 or something like that. The company may automatically cash you out, but there could be tax implications and things like that. So those are your options. You basically have 4. That guide does list all of your options when you leave a job.
It's not liquid net worth. So and then the way for young people to do it is house hack. You ever heard of that term? You have roommates in college. Keep your roommates going. Just because lower those
we appreciate
costs
you guys.
in your
Thank
20s
you.
where it's okay. You can live a bohemian Spartan life to get started.
Well, you shot down the rice and beans. I'm like, that's all I ate growing up. That's literally like all my
and
mom
then the other thing is, don't get the new car with the big car payment. The average cost of a new car now is $50,000. Yeah. And you can buy cars take the 3 to 5 year old, even 10-year-old car. Take the millionaires drive Toyotas. Multimillionaires drive Toyotas.
20-year-old Toyota.
Yeah, there you go. I mean, but keep doing that.
Yeah. I just need A to B.
There's a huge difference between rich and wealthy.
Yeah.
And people don't understand that. That's why I call it the rich doctor syndrome versus the wealthy doctor syndrome. Anyway, so take care of housing, transportation, and food. Don't eat out all the time. Don't order DoorDash. It'll all add up. Just track it with Monarch and realize, oh my God, you will be shocked. Yeah. And you will find money in all these nooks and crannies that you can throw at your freedom. And then travel is another one, but that's an experience.
Yeah.
Don't overdo it, but you're going to go to friends' weddings and stuff. You get one chance at that.
That's true.
So you should go. One of the regrets of one of these frugal rice and beans guys that was retired at 30 was he didn't go to a bachelor party.
Wow.
Because he was,
That's missing out.
Yeah, and we talked about it with him on the podcast, and he has a good deal of regrets that he was too aggressive. I mean, there's a balanced life, and the balance is generally, if you start early, with a 20, 25, 30% savings rate. Mm-hmm. And if you have enough money and you can push it to 40 and just leave the lifestyle, because there's a book called The Millionaire Next Door.
Okay.
And that's an old book. The guy's name is Danko. His daughter did The Next Millionaire Next Door. But these are all the characteristics of people, like the most common car they drive. They never buy a watch more than $300. And this all has to be inflated and stuff. But they don't care to look rich. They don't buy Gucci and all these name brands, and they don't mind thrifting and going to stores with secondhand clothes.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. And our editor is Fritz Brazard. We love them and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptophi.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to Phi. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to Phi. Cheers.